All right, everyone, we are live. Welcome, welcome, welcome. Looks like we've got some people that have joined us already, so excited to have you with us. If you would just drop in the chat box there where it is you are connecting from, just so we can see and we can see where everybody's coming in from, and then we'll get started here in just a minute. Got an exciting night for you here of what a great multifamily deal looks like. We've got some experts on multifamily, some really great operators. I believe combined, we have over 10,000 units represented. I think about 8,000 of those units are Mark Kenney. So glad Mark is here to anchor the group. So excited to have everyone here for that. Looks like we're getting some people to respond. We got Taylor in Seattle, Amy in NYC. Just drop in where you're coming from. We got Cleveland, Siraj in NC, North Carolina. We've got Jamie in Arizona. Darren's joining us. Welcome, Darren. Idaho, Alan, and Jamie. So you keep dropping your names in there, and then we'll go ahead and introduce this group and the kind of what we're doing here. So, and Kirk, welcome, Kirk from Utah. So my name is Bronson Hill. I'm the CEO of Bronson Equity. We do these monthly investor events to help you invest in your own education, because really that's the best investment that you can make, is educating yourself. It will save you a lot of money. It will save you a lot of time. It will also make you a lot of money. And so we're really excited to be able to do this. We do this typically, the third Wednesday of the month. So we'll talk about the next one coming up, which is a very exciting one that we're going to talk about inflation. We got some just amazing speakers for that. So I'll share that in a little bit. So for this particular event, what does a great multifamily look like? I'm going to introduce our panelists and our experts here. So I'll just kind of go down the list here. So we have Mark Kenney, and he is the co-founder of Think Multifamily. And he's a general partner in over 8,000 units and runs a coaching community as well. Has a great community. I was at one of their events last month, and it was great. So welcome, Mark. Would you just wave your hands so people can see you? All right.
Thanks, Bronson.
Good to have you with us today. We've got Brian Briscoe. Brian is the co-founder and principal in the real estate investing firm Four Oaks Capital. They have 485 units worth over 21 million under asset management, and he hosts the Diary of an Apartment Investor podcast. So welcome, Brian. Good to have you. Oh, looks like you went mute there for a sec, or we lost your audio there. So, looks like we lost you. Okay. We will see if we can get your, if for some reason your audio is not working, we'll just have you exit the room and then jump back in. Cody, we have Cody Laughlin, who is also known as Real Estate Cody, a little hashtag we came up with. He's a real estate entrepreneur, podcaster, meetup host with 10 years of real estate investing experience. He's the founder of Prosperity through Multifamily Real Estate, and he hosts a podcast as well. And they have 128 units. Welcome, Cody. How are you doing tonight?
Great, Bronson. Thank you so much for having me tonight.
Awesome. Good for you to be here. So, okay, so we'll go ahead and jump in, and I believe we're going to have Brian's going to jump back in here as well as soon as he gets his mic squared away. But let's just talk for a minute. So today we're talking about what a great multifamily deal looks like. So, first of all, why is this topic so important? If someone's new, why is it important to understand what a good deal looks like? And just somebody can jump in. I guess we can start with. Yeah, just jump. Why don't you jump in, Mark?
So for me, it really doesn't matter what part of the deal you're going to be involved in. You need to understand whether the deal makes sense or not. I'm sure we'll talk more about that. But the reality is whether you're going to look for a deal, sign on a loan, potentially help raise capital, asset manage, whatever it might be, you don't be set up for failure, right? So understanding the different aspects of a deal, you don't have to be the guy in Excel, 5 hours a day. Some people want to do that. A lot of people don't want to do that. But at a minimum, you need to understand the key factors to look at to see, hey, on the surface, it looked like it's legit. Are they maybe playing some games on certain aspects of it? So you need to be able to pinpoint those things no matter what. And again, no matter what role you're going to have in the deal, you need to understand if it's a good deal or not.
Hey, right, Bronson, can you hear me now?
I can hear you now. So you're coming in clear. So
awesome.
Brian, you want to go ahead and since we got your audio back, why don't you jump in? Why is this topic so important that someone who's new or somebody's been around a while, why is it important they understand, how to analyze or look at a deal and understand what a good deal looks like?
I would say it's just the difference between investing and gambling. I mean, if you want to park your money in something you don't understand, I call that gambling. And if you want to take the time to learn it and to be able to make wise decisions with your money, that's investing. All right. So if you want to be a real estate investor, knowing what a good deal looks like is a prerequisite. Otherwise, you're just throwing your money at the wind.
Absolutely. Yeah. There's that quote in, I think it's Alice in Wonderland. It says, what's the way home, or how do I get where I'm going? And, well, if you don't know where you're going, I'm totally butchering the quote, but it basically any way is fine. So if you don't have a target, you don't know what you're looking for, anything's going to be okay. So it's important to be able to have a target. Cody, what about you? Why is this topic important?
Yeah, I'll echo your sentiments a minute ago, Bronson, and that education is, to me, the key fundamental component of getting started in any type of investing, as Brian just alluded to. I mean, it's the difference between speculating and actually investing. And there's so many dynamics when you invest in these multifamily deals, whether, again, as Mark mentioned, whether it's on the active side or passive side, there's a lot to learn and to know when you're considering getting into these investments, because they're long-term commitments and they're very hard to get out. And so, you could not only put your own capital at risk, but you could put the capital of other investors that are partnering with you at risk if you don't know what you're doing. So it's very, very important that you get good, sound, fundamental education.
Absolutely. Absolutely. No, it's interesting. We talk about this and there's a seriousness to it, because we're talking about money. We're talking about your money. Obviously, people work hard for their money. If you're an investor listening, obviously you should care. No one cares about your investment the way that you do. But I also love talking about it because it has so much potential to go well. There's so many things that can go right. And just being invested in a deal with a great operator can be a phenomenal experience. And I've seen literally the light goes on once people invest, they start getting that cash flow, or they start seeing the deal perform. It's like the whole world opens up, and they go from, investing $50K, a little bit into a deal, and they're like, I want to get all my money into every deal. So it's kind of funny to watch that switch, but it happens. So let's talk about that for a minute. So, why is the right sponsor, why is that so important to find the right group or the right group to invest with? What are, why is that important? And we're just popcorn here, so just jump in.
Yeah, I don't know. I'd say, for one, the right sponsor is relative, right? You might look for a sponsor that communicates every day to you, and a lot of sponsors won't. Other people might say, I don't care. I want someone to communicate, with me once a month with reports, and I want someone available to talk to. I want someone that has done a bunch of deals before. The other thing that's more important in my mind than any of that really is, can you trust them? And I will say it's hard, right? I mean, how do you trust somebody you barely know, or you met at an event? It's tough. Probably all have stories. I know I do, as far as people you thought you trust and things happen. But that's in the number one for me. Their character, their integrity. And you kind of get a gut feel sometimes. If your gut is like, hey, I'm not sure, I don't like this Bronson guy much, then probably don't invest with him, right? Or do more homework before you do. But a lot of it comes down to really your style. And, if someone's going to do deals that are, 50% occupied, big value add deals, and you're like, well, I'm a cash flow guy, I'm going to use it to pay my bills, probably not the right operator. So you have to define as an investor, define yourself, what is important to you, what are non-negotiable things that you can't live without, right? And what are things like, well, just a style difference, because people have different styles for sure. But those are probably the main things I would say.
Yeah. Fit is really important, right? To make sure that you're with the right type of sponsor that matches your goals. And, if you're a cash flow investor, you don't want to be somebody who's like a 10-year hold with no cash flow, or, or vice versa. So just making sure that your goals are aligned. I think that's really important. So what about you, Brian?
Yeah, along the same lines. I mean, I have 2 degrees in math, and it doesn't take 2 degrees for me to know that anybody can put numbers in a spreadsheet. All right. But you're picking the sponsor that can actually deliver the numbers that are in the spreadsheet. And that's really what you're looking for when you're looking at sponsors. I mean, I know a million ways to tweak any spreadsheet to make the numbers just sing. But end of the day, you're not investing in projections. You're investing in somebody's ability to make those projections become a reality.
That's great. Yeah, for sure. What about you, Cody?
Yeah, I would echo, Mark and Brian both. And, if you've been in the industry for any length of time, you probably heard the quote that, a bad operator can take a good deal and make it bad, and a good operator can take a bad deal and make it a good deal. And so the point to that is the operator or the sponsor is the most important aspect of the deal, because ultimately you're putting your trust, your faith, and your capital, your investment in with these partners in the hopes that they can execute and manage the business plan. So they're the driver of the ship, so to speak. So they're absolutely the most important component of the deal.
Yeah, for sure. No, I think there's a lot we can get into there. Just for those that have joined us here, we are going to take questions at the end as well. So you're certainly welcome to drop questions in the chat box. But if you want to make a note, we're going to come back to those questions at the end. So definitely stay tuned. We will circle on that. So let's dig in a little more as far as a great sponsor, kind of best in class. Like, what do you guys see? Like, these are specific things. Obviously, a fit is important, similar objectives and things like that. But what are just some signs that, okay, this is somebody who kind of knows what they're doing? This is a group that I should consider investing with because, they have the experience. They got whatever sort of things that is. Mark, do you want to maybe start and we'll just kind of go around the horn here?
Yeah, I mean, you touched on a few of them we did on the previous question too, but a lot of it comes down to what's their experience. I mean, experience by itself isn't necessarily going to benefit somebody, right? You can have bad experiences. You could do things, if you're training or whatever, you could do things wrong. But end of the day, how many deals have you done? It's hard. It's, pretty hard to argue if someone's done, a dozen deals that they probably didn't learn. They'll probably learn a lot more than someone's done one deal. Just reality, right? You're going to be doing that. Have they had bad experiences? If they have, what were they? How did they handle them? Did they communicate out? I mean, people don't like communicate bad news, frankly, right? But at the end of the day, people would rather have the bad news than no news at all. That goes back to the style. And then just kind of how they set up. I mean, are they full-time? Are they doing it on the side? And it doesn't mean any of these things are bad. It doesn't at all, right? I mean, a lot of people start out that way. But are they full-time? Are they on the side? Are they actually dedicated 100% to just real estate? Are they dabbling in it and doing 10 other businesses, which a lot of people do? Or is it kind of what their number one priority is, and that's what their life is built on? So those are probably the main things I would look for.
I think one thing you said was about delivering bad news. Ken McElroy says you develop trust when you deliver bad news. And I think it's really true. And so that question, if, hey, what went wrong in a deal? If they kind of just say everything's been fine, or either they're inexperienced or they're just not being really truthful, because things don't go perfectly in deals, right? They go better, they go worse. And if they don't have something they've learned, then I think we're missing something there. What about you, Brian?
It's hard to follow up. I kind of made a little mental checklist of things I wanted to go through, and Mark just went down and hit every little item. But
maybe I should end with Mark instead of start with Mark.
Yeah, so it's a tough act to follow. But no, Mark, great thing. End of the day, there's a lot of things to look at. And I think with investing in real estate and a lot of the things we're going to talk about tonight, it's all risk versus reward. There's certain profiles that are a little riskier than others. Do you want to invest with that brand new investor? It is a little riskier to invest with the new investor, but just make sure you understand the big picture. And what Mark said, there's a lot of good stuff there. Whether they have experience, whether they're working full time in the business or not. But just look at it from a risk versus reward perspective. I think that'll help out a lot.
That's great. Thank you. Cody, what about you? Anything to add?
Yeah, I think oftentimes, when we talk about experience, it's equated with either unit count or years in the business. And all of those are very important factors when considering the bench strength of a sponsor. But I think we've got to dive a little bit deeper into, and I think, for me, one of the most important aspects of what makes a good sponsor is what is their history of performance. How often have they met pro forma projections? How often have they paid out distributions as projected? And how well have they managed the communication and investor relations, right? And then, as Mark mentioned as well, are they battle tested? Have they been through tough circumstances? How did they manage it? How did they communicate it? And what were the troubleshooting strategies that they went through to recover and get the opportunity hopefully back on track? So I think you got to dive deep into that, but I don't necessarily look at just the unit count and years of experience. I definitely want to dig into more of the performance of the sponsor, more so than just the years.
Yeah, it sounds like there's a theme there of, experience does not mean that you're great. It can be easier maybe to raise money or to get deals, but it doesn't mean the deals will necessarily perform well. So that is something definitely to pay attention to. So let's get into this a little more. We've talked about, people mentioned a couple things, but what are some things that you would see as far as red flags? Like when you see this in a sponsor, if the communication's this way, if the deal looks this way, if something happens, and we can kind of go reverse direction. I don't know if Cody, you want to start with that, and then we'll kind of work our way back around there.
Sure. I think we touched on a few points in the previous question as well, but I would definitely say one, lack of transparency. and lack of accessibility or communication, right? And so transparency, maybe on the assumptions or underwriting of the pro forma, not being willing to show some of the due diligence items or some of the data that's collected to justify some of these assumptions in the business plan. And, communication wise, if I'm trying to get a hold of my sponsor and I'm not hearing anything back from them till next quarter, for me, that might make me a little uneasy. I don't need to talk to them every day, but I want to know that they're there, that open line of communication is there. And so I would say, to me, those are the two biggest red flags that I would look for.
Yeah, I think for us, we do, any piece of information they need, it's all there. And then we make a rule that within 1 to 2 business days, hopefully one day, but up to 2 business days, we're going to get back as soon as we can, sometimes right away. But this communication obviously is very important. And the worst thing is you invest in a deal, you reach out, you never hear anything. And it's just like the worst experience. You've just wired somebody $50K or $100K, maybe you don't know them, even never met them in person. And you're like, where's my money? What's going on here? So people responding obviously is very important. Brian, what about you? What are some red flags that you've seen or you've been aware of?
A couple of things is just, I think a lot of people tend to have, or red flags in my mind, when people tend to have a very rosy outlook on the future. There was a deal that we saw and passed on, and another operator picked it up, and I happened to be on their distro list. But they were assuming that things were going to be a lot rosier than most people would think. They were assuming they'd be able to refi 3 years from now at a low 3%. And maybe they can't, and so I would just say one of the biggest red flags is just ask people, talk to them about what their projections are of the future, what their rent growth projections are on the future, what their interest rate projections are on the future, what their cap rate projections are on the future, because a lot of people will, to make deals work, kind of inflate these numbers. And that's one easy thing on a spreadsheet, just to touch up a tiny bit. Hey, if I assume my interest rate is going to be at a 3.1% when I refinance 3 years from now, every deal is going to be screaming. So really that's the biggest red flag to me. But once again, I'm a math guy by trade. But and the other thing is just if you talk to them, ask them questions, and your spidey senses start tingling, that's probably an indication that you need to look somewhere else.
Yeah, I got to pay attention to your gut. That's definitely a good one for sure. Mark, anything else to add there?
I mean, those are great comments for sure. I mean, the one thing I would say along with Cody is, sharing assumptions and things like that, but sharing trailing 12, rent roll. If you are educated, you can look at that. If you're not, don't ask for stuff that's useless to look at, right? But I know some sponsors before that people ask for the T12, and you're going to be investing in a business, and they won't share that, which blows my mind actually. But that would be a red flag for sure. Or if someone can't do something like, we can't, the lender has a problem with that particular sponsor for whatever reason. Or, if you hear things, ask, hey, I heard this about you. You can ask a question, right? You're going to invest in it and see what they say. Or if you ask them, is there anything you don't like about the deal? Most deals we buy, there's something I don't like about it. It just is. And I'll tell you what it is. And that might be like, well, that's okay. It doesn't bother me. That's totally fine. It might be, that's a big deal to me as an investor, and therefore I don't want to invest in the deal. So just being, everyone mentioned it, right, Cody, and stuff like that, being transparent, sharing those things, and just being genuine, basically, and not trying to just get somebody in the deal to get their money, but really trying to be an advisor to them, which is hard at first when you're trying to raise potentially millions of dollars. But you get to the point where you're like, I'm going to be more of an advisor, and maybe even talk people out of investing in a deal I have, and or investing less in a deal, which sounds strange, but it'll go a long way in the future to do that.
Yeah, I think you touched on something too, that, it's not just about a deal. And I think all of us raise money for deals. And, the way I look at it is like, it's not about the deal we're doing. It's about 5 years from now, about an investor having a phenomenal experience, hopefully having referred friends and family and wanting to get in every deal that you're doing, because it's a long-term relationship, right? And so I think that kind of feeling you get when talking, because I'm a passive investor as well. When you talk with a sponsor, it's kind of like, hey, whether you invest this deal or not, it's fine. Like, we'll get the money, we'll figure it out, but the relationship is more important. And I think those are the people, whether it's buying a car or it's investing in a deal or anything, it's just, it's a high trust way of communicating, right? It's a way that we're actually, you sense that people are really there to help more than they're there just to sell you what they got to sell. So I think that's a big deal. So let's talk about that for a minute. I know a lot of people are kind of new here, kind of new to this space. So what are some ways, if somebody doesn't have 2 math degrees like Brian and you're looking at a deal, and you're not a CPA like Mark and Cody, we're, you're numbers guys, but what are the things to look for in a deal, particularly when it comes to the numbers where people try to fudge the numbers sometimes? Like maybe, I know we touched on that a little bit, but maybe we can just go a little more in detail of what are a couple of those things that if you're looking at a deal, these are things you should look for. And just whoever wants to jump in, feel free.
Yeah, I would say rent growth is probably one of the easiest things to fudge and everybody is going to have some sort of projection on what the future looks like. That's how we come up with our numbers, and year over year, there are rent hikes in most areas. A lot of it's due to inflation. Some of it's a supply and demand thing, but, really just pay attention to what those numbers are. And are they realistic? It's pretty easy. You can just do a Google search and figure things out. What's the average rent growth in, XYZ metropolis, and you can see what it's been historically. So, if somebody's pitching you a deal in Detroit with a 5% year over year rent growth, and you do a Google search and see that rents haven't grown in Detroit in 10 years, you probably should walk away from that one. But end of the day, I think that's one of the easiest things to fudge is just how much you can expect those market rents to go up year over year.
Yeah, I think I think rent growth is one of the biggest ones. We'd say an area that's 5, like Dallas, I don't know if it's 4.5%, 5%, whatever the rent growth historically has been, to do about half of that going forward. But any other comments on rent growth and what it should be? Because again, you look at a deal, even if it is historic, should we be using going forward, or should a sponsor ever be using those historic figures of 5% rent growth in Dallas or other areas? Or what are your opinions on that?
I don't think so. I don't. Yeah. Great if you get it. But if it's closer to, 2-3% max for a lot after stabilization, right? Your first couple of years, you could be a lot higher than that. You might be putting money into a deal. We have a deal we put, $21,000 a door into it. We have some properties we've raised rents, $300-$400 a month, right? But that's at some point in time, you can't keep doing that, right? It's going to stabilize at some point, and after that, then you're going to be closer to the. People are like, well, today it's 8%, and CoStar projects it's going to be 9% for the next 3 years. Great if it happens, but I wouldn't count on it personally.
Yeah. Brian, you made a great comment.
Cody, looks like you're on mute there, brother.
I can hear him.
Oh, sorry.
Can you hear me, Bronson?
Yes,
okay.
I can.
Sorry, it's delayed a little bit from my end. Go ahead.
Sorry. Yeah, Brian made a great comment earlier a few minutes ago, and it's a perfect answer to this question is, listen, you can fudge any number on a pro forma or a spreadsheet. I can make it look as beautiful as I want it to project whatever returns we want to. Things looking at kind of what these guys just mentioned, the overall effective income growth over the life of the pro forma, what's the operational expense ratio, things like that. If somebody's looking at operating at a 30% expense ratio when you probably should be closer to 50, 55, things like that. But the point being is you can fudge any of these numbers. So, I go back to the point of asking, if I'm looking at or analyzing an opportunity, I would really ask to see some data to support some of these income projections or expense projections, and I'll reference Mark. Mark's got 8,000 units plus. He probably can operate at a different level than what I could, being a newer investor myself or newer operator. So, he has the proof and the concept in his portfolio and whatnot. But I think there's a lot of variables that come into play when you talk about fudging these numbers. So, but again, always ask for supporting data if you have questions.
Yeah, Brian mentioned it earlier. He didn't re-mention it on this question, but he answered another question. Cap rate's probably the number one. I could have, I could change my cap rate to a 2 on the exit, right? And any deal is going to IRR and total return are going to look super high, right? Cash and cash is what it is, right? So you have to concentrate on what the cash and cash is on an annual basis, because I could do certain things in, year 5 and 6 to make it look, or a refi to Brian's point earlier. I'm going to do a refi, and then I'm going to do a supplemental loan 2 years after that. I'm going to do, all these things that just makes the return look much, higher. The other one to look at is economic vacancy. Just think of it as, people that, it's vacancy, people that don't pay, things like that, right? But people are like, oh, the PM agrees with all my rent projections. Well, okay, but how does that translate into income? It doesn't happen day one. So like our analyzer will phase in income over time, right? Depending on 18, 24 months, whatever you put there. But a lot of people take a PM budget, and PMs do it all the time, even ones that are good. They'll say, oh, they're not charging back for other income today. We think that's going to be $100,000. And lo and behold, your very first year, you have 100 grand in other income. And year two, you have, 105,000. Well, yeah. Really? You'd expect to see probably 50,000, maybe, right? Just pick a number year one, but you wouldn't expect to see the full amount in year one. It just doesn't happen that way, but you see it all the time.
Yeah, we see that a lot of times, the year one rent growth, year one assumptions that just all of a sudden out the gate, this thing's going to be a rocket ship. And as you can tell, as we're talking about this, there's a few things, rent growth, cap rates, these are huge levers. I mean, you change the rent growth from, 2.5% to 5%, and your deal's gone from I don't know what the math is, but a 15% to like a 25% plus return per year. So it's crazy. So I would say as an investor, don't be, especially a newer investor, don't be distracted by high numbers, because a lot of operators will have high numbers and just to get people in and then underperform. And I know you guys in general, from what I know about your deals, you'll have modest numbers and then try to outperform them. Say, here's the upside we didn't include in the numbers, and that kind of thing. And those are the type of operators typically that you see just have been around for a long time, have been doing it. So we'll get in a little bit more into deals, but before we do that, let's talk about the word conservative when it comes to underwriting, right? Is that the most overused word, right? People say, oh, it's conservative, right? It's conservative. Yeah. So
everybody underwrites conservatively. Done.
Yeah, pretty much.
Don't need to talk about it anymore.
I'm waiting for the deal that comes out that says this deal is not a conservative investment. I mean, it's funny in the PPM, it says there's risk here. You could lose all your money. Of course, PPMs, you have to put everything, the operator gets struck by lightning or, whatever, but it is an interesting thing. But let's go through some scenarios here and just talk about a specific deal. So let's talk about, and some of these, for people that are a little more experienced is going to be familiar, but let's talk about Class A versus value add. So can somebody maybe just talk about, kind of the differences and why one is better than the other?
I won't talk about why one's better than the other. It's all a risk versus return. Everything has a different risk profile. Everything has a different return profile. We tend to do value adds because there's a lot of history with the projects, so if you buy an apartment that's existed for 30 years, you've got 30 years of rent history behind you, 30 years of occupancy, 30 years of growth statistics and things like that. So, you can pretty much be sure that it's not going to run dry, in the next 6, 8, 12 months, right? So there's one thing about that. Class A's, on the other hand, depending on when you buy it in the process, a Class A is only a Class A for 5 or 10 years unless they keep on dumping money into it. But you're not going to have that same rent history. And then the one thing I do like about value add is the forced appreciation. There's natural appreciation that works for all real estate. There's going to be inflation, and because there's inflation, the price of real estate is going to go up. But with the value add, just like fix and flippers do, you go in, you renovate, you make it look pretty, you make it look nicer, you can raise rents, and you can force the price of the property or force the value of the property to go up. So me particularly, I like value add. I think it's a little more, like I said, for cash flow perspective, there's a lot more history behind it, and you can control your returns a little more than maybe you can on a Class A where you're just banking on appreciation.
Absolutely. No, that's true. The value add component, there's a little more safety there because you get that bump. So can someone else add anything to that? Or if you
I'll
do a
be
nice
just
job summing it up there.
I'll just be real brief. I echo Brian's sentiments there. I mean, I think it boils down to what's your investing thesis and what's your investment philosophy. And, the value add play is where we typically lean more to. We like the forced appreciation. We like to be able to go in there and capture some of that potential upside versus the A class, where the upside is captured either at the development stage or during the lease up. And so it's just a different play and different model. A class does have some benefits. I would say usually typically dealing with a higher profile demographic, probably in a better location. So, if that suits your appetite, then there's some opportunity there. So I think it just boils down to what your investing thesis is. But I agree with Brian. Right now, for us, the value add model is our preferred investment criteria.
And go ahead, Mark, sir.
As you say, there are varying levels of value add, right? I mean, we bought properties that literally 0% occupied and 26% occupied, and you could buy a 90% occupied value add, right? So to Brian's point, there's definitely a different risk profile buying a property, 26% occupied. First one we did, probably that was the most, was 68%. That was the first kind of larger value add we did. But we did a refi after, like 15 months and pulled out all the equity. So we pulled out 87% of the equity on a refi, plus we get paid distribution. So that's pretty tough to do on a Class A property. And it's pretty tough to do on a value add property, right? That's extreme. It really is. But when people make these comments like, oh, value add is bad, or bridge loans are bad, or get educated first and you decide. I can tell you, I have 22 bridge loans, and, we've done really well with a lot of the deals we've done on bridge loans because, to both Cody and Brian's point, you can actually add value to it, pull out a bunch of money, hopefully, right? Hopefully tax free as well, and still own the property. And you have an asset you put, one we put $21,000 a door into, which is a lot for multifamily, and you have essentially almost a new asset as far as inside and out. So I don't think it's one is better than the other, and maybe you mix it up. I probably wouldn't buy all 0% occupied buildings personally.
Mm-hmm.
I wouldn't feel comfortable doing that either, because it's there's more risk involved, takes longer to do. Sometimes you're going to be over budget, and there are more headaches, but there are more rewards typically for it too.
Absolutely. No, it's a good conversation too, because a lot of people like looking at new flashy stuff thinking, oh, I would totally live here, but the returns are way lower. Mm-hmm. And that's why we see a lot of institutions buy these places, and the returns, you can invest in really big and institutional stuff, but the returns might be 6 or 8% per year versus if we're getting 15% plus per year in a value add deal, because you get that bump on the other end. So I know all of us are to different levels value add, sponsors as well. So we're going to get into a couple more topics here. Let's debate this one. And again, feel free to disagree. What is better, preferred return or a straight split, equity split? Who would like to go first?
As a sponsor, I would rather not have preferred return as a sponsor. Just equity split right down, whatever it is, 70-30, 80-20. As a passive investor, I'd rather have a preferred return. Some people might not know even what it is. So just real quick, right? Preferred return means that, let's say it's 8%, and I'm investing in Bronson's deal. It means that I, as an investor, will get the first 8% before Bronson gets anything. He's leading the deal. I'm an investor. And then anything above that 8%, then there's going to be some sort of split. Maybe 70% goes to me and 30% goes to Bronson. But I've invested in both. So, I think it's depends what you're looking for. But yeah, as an investor, I'd rather have preferred return.
Yeah, absolutely. Who else? Who's going to jump in here?
I also like the straight split, as a GP, and I think it aligns interests better. I mean, if you look at the preferred return, we buy value adds, and value add properties are value add because they're not being operated efficiently. So if you're coming in year one saying, I'm going to give you an 8% pref, a lot of value add properties that we look at aren't going to support an 8% pref year one. All right. They're probably not going to support a 6 pref year one, right. So it takes 2 to 3 years to get these operating efficiently again. And as a sponsor and as an investor, the last thing that I would want is to be behind on a pref, because as a sponsor, if we tell you we're giving you a 6 pref and year one, we give you 3%, guess what? Year two, we owe you 9%, and it carries forward. And I don't think anybody wants to be in that position of playing catch up. It's a frustrating position for both GP and for the investors as well. So, to that end, we're still going to do everything we can to make sure we're maximizing those returns. But end of the day, we just do a straight split. We start with an 80-20, go straight split. And if the deal supports it during underwriting, we may move the needle a little bit once we get up past 12 to 15% for the investors.
Sure. Thanks.
Brian, you took the answers right out of my mouth, because that I completely agree with you. it keeps the alignment, the incentive alignment aligned all the way throughout the life of the project, right? Because if as a sponsor, you're supposed to be paying a pref and you're behind, if the LPs aren't getting their pref, then that means you, the GP, aren't getting paid. If you're dependent on that income and those fees, guess what? Your incentive is now to go transact again because you need another acquisition fee, right? You've got to continue to pay your bills. So the alignment of interest starts to deviate. So I think with the straight equity split, the alignment stays throughout the entire period of the holding period. The other thing that I would tell you too is it's a simple model to explain, right? Yes. With the pref model, sometimes you have hurdles, sometimes you have different waterfall structures. And so when you talk about the straight equity split, it's very simple and easy to explain to any investor. And so from both an LP position and a sponsor position, I like the straight equity split over the preferred return. Now, as an LP, will I take a preferred return? Sure. But I favor the straight equity split.
Yeah, I've done both as a sponsor, preferred and straight split, as well as a passive investor. And we've got 2 deals right now. One is a 8% preferred, and the other is a straight split. And it's there's pluses and minuses, right? There's pluses and minuses to both based on who the group is, their track record, kind of how the deal works, and but I think it's just important to understand. So cool. That's a good little transition. So let's talk about fees. So there are fees involved. You know, a lot of times we have an acquisition fee when the property is purchased. Sometimes there's a disposition fee or refinance fee when the property is refinanced or sold. You'll have some sort of asset management fee along the way, and then there's the equity split of profits. But would you see in a particular? Now we're talking about multifamily, so let's stick to multifamily value add deals. What are appropriate fees, or are there sometimes you see fees that are excessive? And anybody can just jump in on this one.
I've seen some excessive deal fees, but it's all relative. If the deal actually works out the way they projected, you'd be fine with it, right? So the problem is it might not. I've seen, there's a guy that used to do self-storage. I know he used to do a 7% acquisition fee. That's pretty darn high. I've never heard anyone taking that high before, but he does. As far as what we've seen, as far as number wise, usually take 2% acquisition fee on the purchase price. You can do more, you can do less, but 2% is pretty common. Asset management fees, 1.5% to 2% is what we typically see of total, income collected for the month. Disposition fee, refi fee, those can vary. Lots of times they're 0. We'll see lots of times it's between 1% and 2%, but I've seen it as high as like 4% on an exit. The fact is there's a lot of work that goes into a refi, a lot of work that goes into a sale. A lot of us, I don't know with Cody and Brian, but when we started out, we didn't take any of those fees, and we really don't take much today either on those exit fees and stuff like that. But frankly, we should start doing it. So we have a deal right now. We're taking more of those fees, but that's what we've seen more as far as kind of general fees. 5%, 6%, 7% acquisition fee seems a bit excessive to me, but
right.
Yeah. Mark, if I could piggyback off that, I agree with you. And I think as a passive investor, you want your sponsors to be incentivized and be compensated for the work, because it is a lot of work that goes into both getting the deal to the closing table and managing the deal afterwards. So you want there to be some fee incentive structure so they can get compensated. But I equate the fee structure with kind of experience, right? And as Mark mentioned, we've seen acquisition fees as high as 5% in the multifamily space from our end. But that was with an experienced operator who, had, 20 plus deals, has taken a certain amount of deals full cycle, and has that track record of performance to probably justify that acquisition fee. So if I'm just starting out, we're going to be very conservative in our fee structure, if any at all, on some of those. So, but I definitely think it just depended on the track record of the sponsor and their history of performance and to justify that fee structure.
Yeah. The only thing I'd say is there's a lot of different levers where the GP can get paid. Okay. And I like to look at alignment between GPs and LPs. And one thing that we don't do personally, we don't do like the disposition fees or a refinance fee, because that incentivizes us to sell the property. And going back to what Cody said earlier, if we're not meeting our pref, and there's an easy way to get out of the property by selling that we make a profit, that doesn't align things between us and our investors. So what I would say about the fee, acquisition fees, I think everybody throws those in, but I would be wary if you have acquisition fee, refinance fee, disposition fee, asset management fee, and you're doing a 70-30 split at the same time. So look at the overall GP compensation, what that looks like. If somebody has a larger upfront fee than a fee at the end, maybe that's okay. But I think you have to look at it holistically.
Yeah, I think too, it depends on the size of the lift too, right? So if you're doing like a ground up construction, usually some of these fees are a little higher, or the split's a little more generous to the sponsor. So if you're taking a distressed property, maybe there's some more fees built into a deal, and that can make more sense, especially with a really established operator in a certain thing. But so we're going to shift here in a couple of minutes. If you guys have any questions, you can start dropping them in the chat box. And we've got a couple questions here, but please go ahead and drop some questions, and we'll kind of take them as they come. But I know you guys are all stellar operators. You're great guys. I know all you guys. That's why you're here. So you guys are obviously people that, your sponsors that people can reach out to for deals. So they can reach out to you, and we'll, have the contact information shared at the end. But how are some ways people can find out about more deals? Just in general.
Meetups, events. I think personally, I think the face-to-face, and a lot of people haven't been able to do face-to-face for a while, but we've been having events face-to-face since August last year, and other people are having live events now, which I think is great. You're not comfortable going, then don't go. That's reality, right? If you're comfortable going, then go. But there's nothing that replaces the face-to-face. You want to go to places, in my mind, that are, if you're interested in multifamily, go to multifamily events. Don't go to these generic meetups that are real estate, in my mind, because you're going to find that a lot of people there probably aren't doing multifamily. So I don't think anything replaces the face-to-face. And then just ask people that are like in an event like this, right? People can ask people, hey, sort of contacts of people they invested with. I have people that invest with me, and I have a couple other, leads, if you want to say, that I refer people to personally. And people who say, well, why would you do that? It takes away from you as a, potential someone investing in your deal. Well, because reality is I trust these guys, and I know people, want to spread their risk around. So just ask around. It's a pretty small world. Bigger Pockets, another great resource, probably to get some contacts there as far as syndicators as well.
All good resources. I'll just add that reach out and once you get a contact, once you hear of a sponsor, reach out and ask them, talk to them. We do 506Bs, which is SEC exemption, but basically I can't show you a deal unless I have a relationship of some sort with you. Okay, so if you're interested in investing with me or anybody on the panel or any sponsor in general, reach out to them, contact them, let them know that you're interested, and that can start a relationship. And now all of a sudden, if they're doing a 506B syndication, they can now show you a deal.
Yeah, I would echo the same sentiments. I think networking ultimately is probably going to be your number one funnel for deal sourcing as you expand your database, especially with other operators. It's a great way. Get on their distribution list, stay active in what they're doing in their business, get in their circle and build those relationships. Another great medium too is podcasting. If you're subscribing to podcasts and you hear operators coming on, reach out to them, connect with them. And that's why they give out their information. So I think in this digital age, the lack of available deal sourcing is that's on you. It's at your fingertips, right? And so whether it be virtual or live, you can find it. You just got to put yourself out there, and you got to tell people what you're doing. I think you got to tell people your story, and so people know how to find you as well.
Yeah, I think a few things to highlight there, but the primary one I think is getting to events. I think if you're an investor and you've never been to a meetup, you've never been to a live event, I think it's really huge, and that's why I live in Los Angeles. and we're still, you know, you have to wear a mask anywhere you go. Still, you got to put a mask on your dog and your children and whatever else. And you go to Texas and like COVID's not even real. So I mean, I've literally been to Texas every single month with gatherings of 100 to 300 people. I'm coming this weekend. So there are ways to get out there, really experience. And I think it is important to, obviously to your comfort level, to be able to do that. We are getting some questions here. So we're going to kind of go down some of the questions here, and we'll just, again, kind of do popcorn here. So Daniel's asking, when you're vetting a new sponsor, how do you know they haven't lied about their provided historical performance data?
I mean, so here's my take on it. If someone wants to lie to you, steal from you, whatever it might be, you know, people walk into airports with bombs strapped to them, right? So, you know what I mean? It's like, if someone wants to get away with something, they're going to get away with it, but probably only for so long. At some point in time, it's going to catch up to them. Plus, they can get a lot of trouble for it. But you don't really know if someone's lying to you. They're not going to share all their, you know, detailed information with all their past deals and all the financial. They're not going to probably do all that, right? I mean, most people wouldn't do that. So you're not going to really know. And even if they did, they could manipulate those numbers. So at some point in time, I would say you're never going to know 100% whether you can trust somebody. In my mind, you just don't. The people have been surprised. We've all been surprised, I'm sure. But do enough homework and talk to enough people that make you at least feel comfortable that, okay, yeah, I've done enough due diligence where if something did happen, you know, in a bad way, at least I feel like I did the due diligence versus, you know, I just gave $50,000 and I didn't do any due diligence and something bad happened. Now it's on me now, right? So I feel horrible for my family because I messed up.
So what are some steps of due diligence? Like, what would you suggest, Mark? Just maybe like a few bullet points. So here's some things when you're vetting a sponsor.
I mean, I would ask him questions for one. We talked about some of the questions, and I mean, we have, I think we have 20 questions on our website too, but there are, you know, hundreds of questions you could ask. Ask for references. People will say, oh, people aren't going to give bad references. Well, you know what? I had people ask me to give them references before. I mean, I had a guy that actually got fired from a job while he's walking out. He's like, can you use as a reference? I'm like, what? I mean, you know what I mean? You're crazy. But, and then it's a pretty small world, frankly. So if you ask around and say, hey, does anyone know so-and-so? What's their experience been? And, you know, if you hear something that you can ask, right? Sometimes there are two sides to every story. There just are. But, you know, ask the questions as far as deals they've done, you know, have they ever lost money? Have they done a capital call before? All those things like that. And then ask them for some references and things like that. But I don't think there's really enough stuff you could do to say, oh, I did all those things. Now I know Brian's lying to me. I mean, it's pretty tough in my mind. He can manipulate whatever. He's a mathematician, right? 2 degrees. Yeah. He can manipulate anything he wants.
Numbers.
Make it look right.
Numbers.
Yeah. Numbers.
For sure.
Yeah.
We got a bunch of questions. You guys mind if we keep going? I'll just kind of rapid fire them to each of you, or we can kind of jump in, or if you guys want to jump in. So this is from Shalmet. This says, if as operators you are behind on performing with no distributions, would you advise the GPs to reconsider some of their fees? We can hear from either Brian or Cody on that one.
Yes, is my answer. We have one asset. I'm not going to say which. We have one asset that's underperforming, and as a GP, we have 20% of the raised capital. We have not taken a penny from that property, and we funneled everything towards our investors.
Yeah, as operators, I mean, you have a fundamental responsibility to be fiduciaries of other people's interest and capital, and I think that if your investors are not getting paid, then you as the GP, you shouldn't be taking fees or distributions either.
Yeah, I'll take a haircut. I can afford it.
Yeah.
All right, great. And this is from Michelle. Is it appropriate to ask for references from prior projects of the sponsor?
I'd say
yes.
For sure.
For sure. Now, I wanted to share this. We've had a couple different groups that I work with. There's been sometimes an issue of not necessarily finding people that are fans, but just wealthy people that are busy, don't always like to take a 30-minute call from a potential investor. And so you can wear your references out as well, which is also an issue as a sponsor. I don't know if you guys have dealt with that, but we've had that where we'll get, so what I tell people sometimes is, hey, read all the information, watch the webinar, then I'll pass on so sometimes it's kind of a weird thing. You'll get people that are giving you hundreds of thousands of dollars, and then you're trying to, hey, can you get on the phone for 3 hours this week and have conversations with potential investors? So have you guys come across that? Mark, have you come across that at all?
Yeah, I mean, initially probably yes. Now not as much. And you could do some other things too. You could maybe get a letter, and you could say, well, how do I know the letter is correct? Well, how do you know the person you're calling is actually an investor of mine? You have no idea. It could be my brother or my sister. You know what I mean? So, but we have quotes on our website and stuff. Again, you know, take it for what it is, right? But it's people that invested with us and they're giving us quotes. And again, if someone wants to lie to you and pass you off to somebody else, they can do it.
Yeah. Mark, you already pointed this out. I mean, look, this is a relationship business, and I would encourage anybody, take your time when you're vetting or working with a new sponsor that you're not familiar with. You know, don't be so amped up just to jump in just because you think it's a great deal. If you don't feel comfortable after spending time with them going through it, then, you know, just continue to build a relationship, but maybe just wait and give it some more time. But ultimately, you're going to have to take a leap of faith at some point. But it does come down to the relationships.
And right. I would say just don't let the sponsors pressure you. I hate pressure tactics, you know. And here's what I realized a long time ago. You know, we're going to have other deals. And, you know, if I've just met you and, you know, legally I can, you know, meet the 506B requirements and show you the deal and you're not comfortable yet, I'll tell you not to invest. I'm like, hey, let's take a little more time. Let's get to know each other. You know, I don't want you to second guess your decision ever. And, you know, we're going to have another deal. So if not this one, then the next one. I'm playing the long game. I'm not playing the short game.
Great.
I want to go back real quick. So Joseph Bramonti, who's on here, is also a sponsor, had mentioned something that I missed. But basically, we were talking about taking a haircut, and obviously I can't really take much more of a haircut than I've already taken. But Mark, did you say you don't take a haircut on fees, or you don't reduce it, or maybe I missed something there?
No, I didn't say that. No, okay. I didn't say it. Only thing I would say was back to Cody's point earlier is that if you ask or if the GP does that, I'm not living off asset management fees. That's the only fee you're going to take, right? I mean, definitely not taking a distribution if we're not paying GPs. For me, you know, not getting an asset management fee is somewhat meaningless. I mean, to be frank, right? So if you have someone starting out and they're trying to get into this and they're newer and they're, you know, making whatever, pick a number, $1,500, $2,000 a month on an asset management fee, and you're like, well, I don't think you should take it anymore. Or they say maybe you shouldn't take it. You just have to understand, are they going to be as incentivized? Yes or no? Mm-hmm. For me, it would make no difference. I mean, to Brian said the same thing. He doesn't care. He won't do it. But no, I didn't say that.
Okay, sorry. Don't mean to throw a monkey wrench there. Yeah. No, it's definitely important. You know, it's also like, you know, being able to have a sponsor that is paid to go and go take care of the property. That's something that you want to have for that asset management fee. Yeah. So I appreciate that. So I'm sorry to. Okay, let's go down to Irish Kevin here. It looks like how do you confront the seller after discovering lies and bogus financials So let's say you get into a deal as a passive investor and you realize probably, you know, maybe not too long after the deal gets going that, you know, this isn't quite what I signed up for. What are some things you can do as an investor?
Has to be bought out for one. I mean, you have to understand what is it? You know, did someone do something unethical? Did they lie? Did they cheat? Did they steal? That's much different than, hey, that syndicator or operator is trying to, you know, do everything possibly can, but you know, for whatever reason, things happen. I mean, things will happen on a deal, right? Could be even things out of your control, like the city violations or city shutting you down, whatever it might be. But you can be asked to be bought out. They're not required to buy you out at all, but you could ask, hey, I'm not happy with it. Would you consider buying me out? Or you can try to have somebody else buy your shares, things like that. But, you know, complaining every day about it isn't going to help my mind. I don't know.
Sure. Anybody else?
No, the question was with sponsors and sellers, right?
Yeah. So let's say I kind of changed the question a little bit because let's say you get into a deal and you realize that it's not quite what you signed up for. The question is more about lies and bogus financials, which I think, you know, that's more of a fraud issue. And then you may have some legal recourse. But when it comes to, let's just say you get into a deal and, you know, it's not quite, you know, you realize, okay, this maybe wasn't the right thing. And like you said, you could potentially get bought out of any other options people have.
Yeah, I think Mark was dead on, with the options there. You can ask to be bought out, but I think this brings up another topic and probably another rabbit hole we can go down, but you need to understand what your investor rights are. When investing in these deals, you need to understand exactly what's laid out in the PPM before getting into these projects, because they're very easy to get in. They're very difficult to get out. And they are long-term commitments. You're looking at 3, 5, 7-year holds. So you best do your due diligence to understand what your rights are and to avoid some of those situations.
Yeah, and the PPM is there for a reason. I mean, I'll be honest. I mean, the PPM takes your risk to extreme. It's going to tell you every single risk that's in there. Understand what the risks are and ask questions if you don't understand anything as far as the risks go. There are some things where the GPs can be held liable for. There's some things they can't. So, how do you handle it? I would just say cautiously at first, and start with conversation.
Absolutely. Communication is really important, especially when, things, there's challenges with a deal, and there are challenges, I think, with every deal. And that's what some people that are new to this, don't realize. It's a performing asset, but there are areas where it goes great, areas it doesn't go as well. And you hope that as a sponsor, it kind of works out with your conservative projections. So I think that's good. So this is from Daniel. Should rent control be in investors' minds, and should sponsors' projections factor that in? Or I guess that's more a question on, I don't know if any of you guys are buying in areas where there is rent control.
No way.
You would not do it. Yeah, I don't. I live in California. We don't own anything in California where rent control is. There's certain areas. But, how much of that is a fear that it could show up in the areas that you buy in?
We tend to look for the landlord-friendly states and tend to buy in landlord-friendly states. And just to very much generalize it, if you look at a red state, blue state map, the red states are much more likely to be landlord-friendly. Blue states are much more likely to be tenant-friendly states. But we're generally searching for the landlord-friendly states to begin with.
Same.
Yeah, I agree.
Sure, absolutely. Okay, well, we're kind of getting toward the top of the hour here. We wanted to definitely be true to our time. So I'm going to give people a way to kind of get in touch with you guys. Wanted to go over real quick. We do have a couple events coming up. So you'll see this here. I'm going to share my screen. There's 2 events here. I'm going to start with this one. We do a multifamily meetup. You can't see his name, but this is Andrew Cushman. And so Melody, if you're on here, if you could just drop the link to that in here. And then this is coming up Wednesday, June 2nd, which is just a couple weeks from today. So these events kind of tend to be on Wednesdays. You may also get an email about this. And this is another one too. If we take our screens off, you can see the names. But this is basically, are you ready for inflation? We expect this to be a really well-attended event. This is our event next month from 4 to 5 p.m. Pacific time on June 23rd. Jason Hartman, George Gammon, and Russell Gray from the Real Estate Guys. Each of these guys have videos that are over 500,000 views each, and they have awesome stuff on inflation and what you should be doing now to protect yourself for that. So just wanted to mention that, and then we're going to just go around and just say how people can get in touch with you and be able to connect with you if you have any sort of free resource you want to offer. We'll just maybe start with Mark and go around the circle there.
Yeah, easiest probably my email, Mark, M-A-R-K, @thinkmultifamily.com.
Okay, awesome. And Brian?
So easiest way, we have a podcast that I think is pretty cool, Diary of an Apartment Investor. Bronson's been on it, and I'm actually going to bring that up to the front of the stack tomorrow, so it's going to be released as if new. But other than that, Brian Briscoe at fouroakscapital.com, and I'm going to throw that in the chat box.
Awesome. Thanks, man. Thanks for being here, Brian. And Cody?
Yeah. Hey, first off, Bronson, I'd like to thank you so much for having us here. And it's a really big honor to be able to share this virtual stage with both Mark and Brian. I both look to these guys as experts in this space. And so really honored to be here and share this great conversation with you guys. But if you're interested in learning more about passively investing, maybe you're a busy professional and you just want to learn about passive investing, you can check us out at www.blueoakinvest.com/why real estate. We've got a really good blog that talks about some of the things that we covered tonight. understanding risk-adjusted returns, analyzing deals, mistakes to avoid when investing in syndications. You can check that out at www.blueoakinvest.com/blog. And then if you want to reach out to me directly, you can find me at cody@blueoakinvest.com.
Awesome. Well, gentlemen, I have great respect for each of you. I appreciate you taking some time out of your busy day to meet with us. I know that you'd be happy to connect with anybody who's connected on this event. And part of the reason I invited each of you is I know that you are really committed to helping investors to get achieve their financial goals. And I think that's the thing that we all get excited about, right? Is actually being a part of people's journey. And having spoken personally, I've spoken with over 1,000 individual investors, and it's just when that light goes on, it's so exciting. So for everybody here, really the best investment you make is in your own education. So thank you for taking time out to do this. We'd love to hear from you, any sort of feedback or comments, or if you have suggestions for the upcoming months as far as panels we should do. I've learned that we can get some pretty amazing people, so including people that are joining us here tonight. So anyway, appreciate the time. Appreciate everyone here. This replay will go out if you missed the first part. It's been great. It's been a pleasure, and we'll look forward to seeing everybody next month at this event. So thank you so much, gentlemen. Thank you everybody for joining us, and we'll look forward to the next event.
Thanks, Bronson.
Thank you, Bronson.
Absolutely. Thank you, guys.